Hey everyone, and welcome back to the channel. When you start saving for retirement, you inevitably run into the biggest tax question in personal finance: Roth or traditional? Should you pay taxes now, or pay them later? Specifically, we're pitting the Roth IRA against the traditional 401k. These two accounts operate under completely different tax philosophies, and your choice determines whether you get a huge tax break today or total tax freedom in retirement. This isn't just about picking one. It's about optimizing your entire financial picture. Over the next few minutes, we're going to break down the core mechanics, analyze the critical factors that dictate your personal winner, and run through a simple scenario to show you exactly where the tax savings truly lie. The goal is to give you the confidence to make the decision that saves you the most money over your lifetime. Let's get started. The fundamental difference between Roth and traditional accounts boils down to one simple question: when do you want to pay the tax? First up, the traditional 401k. Tax break today. A traditional 401k is funded with pre-tax dollars. Your contributions are immediately deducted from your gross income, lowering your taxable income for the year. This gives you an immediate tax break. For example, if you contribute $10,000 and are in the 24% tax bracket, you save $2,400 on your tax bill right now. The catch? All withdrawals in retirement, both your contributions and all that sweet growth, are taxed as ordinary income. Now for the Roth IRA. Tax freedom later. A Roth IRA is funded with after-tax dollars. You pay the income tax on that money today, so there is no immediate tax deduction. The powerful benefit, however, is that all the money grows tax-free, and qualified withdrawals in retirement are completely tax-free. Imagine paying tax on $10,000 today, watching it grow into $300,000, and then paying zero tax on the $300,000 harvest. The taxman gets his cut only once. You are essentially betting on whether your tax rate will be higher now or higher in retirement. While the tax timing is crucial, the actual structure of these accounts also plays a massive role in your savings potential and flexibility. Let's talk about the employer match. This is the most compelling argument for the traditional 401k. The 401k is an employer-sponsored plan, and many employers offer a matching contribution, often 3% to 6% of your salary. This is free money, and you should always contribute at least enough to get the full match. A Roth IRA, being an individual account, has no employer match. Don't leave free money on the table. Next, contribution limits. This is where the 401k wins big. The annual contribution limit for a 401k is substantially higher than the IRA limit. This higher limit means you can shelter more of your income from taxes immediately with a traditional 401k, or grow more money tax-free later with a Roth 401k. High earners who want to max out their savings capacity must prioritize the 401k. Then there are income limits. This is a major restriction for the Roth IRA. If your income is too high, you may be prohibited from contributing to a Roth IRA entirely. The traditional 401k, on the other hand, has no income restrictions on participation, making it accessible to everyone with an employer who offers one. And finally, flexibility. The Roth IRA offers superior flexibility. Because you contribute with already taxed money, you can withdraw your original Roth contributions, not the earnings, at any time, for any reason, tax-free and penalty-free. This offers a great emergency fund safety net that the traditional 401k simply does not provide. So who wins? The core rule of thumb for choosing between Roth and traditional is based on your current tax rate versus your expected retirement tax rate. You should consider a traditional 401k if your current tax rate is higher than you expect it to be in retirement. This is the typical scenario for high-income earners in their peak earning years. They're in a high tax bracket, say 32% or 35%, and get the maximum benefit from that upfront tax deduction. They expect that in retirement, with no salary, their income will fall, and they'll be in a lower effective tax bracket, maybe 15% or 20%. They defer paying a 35% tax today to pay only a 20% tax later, a clear win. On the flip side, you should lean toward a Roth IRA if your current tax rate is lower than you expect it to be in retirement. This often applies to young investors just starting their careers, or people who anticipate massive income growth down the road. You might be in a lower bracket, say 12% or 22% today. In this case, you'd prefer to pay that lower tax rate now to allow a much larger balance to grow tax-free forever. For many younger workers, this is the best choice. Two final points can often tip the scales in favor of Roth. First, required minimum distributions, or RMDs. Traditional 401(k)s force you to start withdrawing money and paying taxes on it at age 73. Roth IRAs, however, have no RMDs during the original owner's lifetime. This means your money can continue to grow tax-free for your entire life and can even be passed on to your heirs. Second is tax diversification. The truth is, nobody truly knows what future tax rates will be. They could easily rise. So, the smartest strategy is often to contribute to both traditional and Roth accounts. By having a mix of tax-deferred money in a traditional account and tax-free money in a Roth, you give yourself maximum flexibility in retirement to manage your taxable income and keep yourself in lower tax brackets. This ultimate guide leads to this essential action plan. Step 1. Get the match first. Always contribute enough to your 401(k) to secure the full employer match. This is non-negotiable free money. Step 2. Max out the Roth IRA. If your income allows, prioritize maxing out your Roth IRA next, especially if you're young and in a relatively low tax bracket. This maximizes your tax-free growth potential and withdrawal flexibility. Step 3. Max out the 401(k). If you still have money to save after that, return to your 401(k) and contribute up to the annual limit. This gives you the best combination: free money from the match, tax-free growth from the Roth, and a large current year tax deduction from the traditional 401(k). The most important step, however, is simply to start. Saving consistently is always more important than the specific account you choose. Master these accounts, and you master your retirement. If this guide helped you choose your tax destiny, please hit that like button and subscribe for more deep dive financial guides. Thanks for watching, and I'll see you in the next video.